Thank you very much for the introduction, and thank all of you for being here. I wish they had told me it was going to be a large room. My goodness. It's really exciting to come up here and do this event. I knew Gary Keith well, and I know that he did this for many years, and very tough shoes to fill, of course. And I would echo some of the comments about the optimism up here in this part of the country, in this part of the state, because I've been working, as you heard, with Wilmington Trust since 2015, and in those 8 years, it's never been as exciting up here as I think it is today. I'm going to talk a little bit about some of the challenges that are facing the economy, and then some of the upside momentum that we could be seeing at the national level. And I think a lot of the experiences are similar to what we're seeing up here in upstate New York and central New York. Our outlook for this year, as you can see, is titled Inflationary Vortex, which, truth being told, sometimes you go for a grabby title, right? Get everybody's attention. And we know that inflation has been the dominant feature in economies, in the financial markets, and basically a lot of the uncertainty about the outlook over the past year. And when we say inflationary vortex, it's not because we're expecting inflation to persist at what has been a 40-year high. We peaked at 9.1% last year. It's definitely coming down. What we are talking about and expecting is that inflation will continue to be an issue that businesses and markets are dealing with on a going forward basis. And there are three main reasons for that. You can see that we talk about labor, about China, and about energy as some of those main drivers. Of course, I'm an economist, so I have about 97 slides, but I'm only going to use a few of them. This is showing inflation, year-over-year inflation in the United States, starting in 2003, going all the way through the most recent two recessions. And then off to the right, you can see sort of a band that says 2.5% to 3%. So I use a lot of squiggly lines, of course. This is one of them. But the main takeaway here is that we are entering an environment going forward that is fundamentally different than what you as businesses have been operating in for the past 10 to 15 years. Between the global financial crisis, that first sort of yellow shaded area which indicates a recession, and the COVID-induced recession, sort of a skinnier yellow area over there, in that period, inflation averaged 1.7%. To tell the truth, it was a little bit lower than that at most times, and there were severe downward movements, and it's actually too low for the likes of the Federal Reserve. They spent a lot of that time, including a lot of the time that I was at the Fed, trying to figure out how to push inflation higher. Be careful what you wish for, okay? But they did not create necessarily the inflation over the past couple years. We do expect it to be coming down, as you see from that peak we saw last year, but the real takeaway here, as I was saying, is that we expect inflation to be higher, between 2.5% and 3%, sort of those dotted lines, on a going forward basis, and it's going to continue to be an issue for the Fed. The takeaway for businesses operating in this environment is that the source of capital, investment, interest rates are all going to be very different than they were during those years in between the two recessions. So let's talk about some of the reasons for it. As I said, the labor market, China, and also energy markets. The labor market is key here. It's the first theme for a reason. It's going to be the dominant driver. It's one of the biggest challenges that we are operating in. I think the group here, CenterState, put together an excellent summary of the economic forecast and surveys of local businesses. 58.9% of respondents saying that labor availability is their key issue right now here in this region. Also, 32.3% saying that benefits and costs are one of their main issues. Labor is a challenge, and this is why. This is showing the overall U.S. labor force shortfall relative to what we would have expected before the pandemic. Because labor force is usually kind of a slowly moving thing. It's a line that moves up and to the right on a chart, if you will. It was slowing in the United States because of the retirement of the baby boomer generation. For all of my couple of decades of being an economist, we knew that the retirement of the baby boomer generation was coming, 10,000 people becoming eligible for retirement every day. How are we going to replace these workers? So you've got basically your potential labor force would still be moving up but slowing down. Then the pandemic happens and you get what I'm showing here, which is the actual labor force, the number of people participating in the workforce relative to where we would have expected it to be. Of course, when you shut down the economy, it's much lower. You've got a shortfall of 9 million people. That wasn't as detrimental to wages and production because there was a pandemic and people were locked in their homes, and I'm sure you all remember a challenging time. Even though there have been dramatic improvements, as you can see, we estimate that there's more than 3 million people shortage of what we would have expected before the pandemic, and that's at a time where the economy, the overall economy in a GDP sense, has returned and surpassed pre-pandemic levels. That's what's causing all of those shortages. Businesses have orders, but there's simply not as many people around to fulfill those orders, if you will. Those 3 million people we break down into basically 3 categories: retirement, immigration, and just a few categories, a few age groups that have not yet returned to the labor force in the same way that we would have expected. And retirement really is the big one here. In 2018, 19, and in 2020, even in the pandemic year, the S&P 500 grew at an annualized rate of 24%. Over the course of 3 years, that doubles the S&P, and by extension, does really good things to retirement accounts. And then you hit people with a pandemic, they're in their homes, you ask them to help out with the grandkids or any kind of care like that, and it's very easy, if your retirement account has done well, to say, I'm going to retire a little bit earlier than anticipated. So if you thought 10,000 people were going to be retiring each day and you accelerate a whole bunch of that retirement into a single year, you're going to have a labor shortage. And I think the real takeaway here is that that is going to be persistent. We say in our full report, which is available on our website, that there are some indications that some retirees are going to be coming back to the labor force because of economic conditions. But for the most part, that shortfall of 1 million people is gone. And that creates challenges. It creates the need for businesses to innovate, to make more with less people. One of the forward-looking reasons for optimism in your local economic forecast produced by the organization, 62.3% have a positive value on their belief that innovation and basically higher productivity is the way that I would say it, is the way forward, making those capital investments. And that is going to be key. The second source of the shortage here is immigration. And we're not distinguishing between legal and illegal immigration. On a net basis, adding those two together, we would typically, over the previous decade, get about a net positive of 1 million people into our economy, the US economy, from immigration. That slowed dramatically during the pandemic, both legal and illegal, because of travel restrictions, because of the inability to process H-1B visas for those highly talented individuals. And we dropped to about 250,000, which is very different from the kind of labor force inflows that you would expect to see otherwise. So we had shortages both in those high-skilled immigrants that were coming to the country, and then also illegal immigration. I'm not making political statements at all on whether that is good, bad, or indifferent, but estimates for the leisure and hospitality industry are that they rely about 25% of their workforce on illegal immigrants. And of course, leisure and hospitality is one of those places where we've seen a dearth of labor, creating some of those challenges. The third category, as I said, is people, just some categories who have not fully returned to the workforce. Some of that is the retirement, some of that is sort of the middle ages who have just not yet returned, but we see some encouraging signs there. But the takeaway here really is that this shortage is not coming from some short-term fluctuation. It's here, it's with us to stay, and that requires areas like this to be competitive and drawing labor towards your area, and then also, as I was saying, relying on innovation. And I think that that is really a point of optimism that the respondents to your local economic forecast are looking for that innovation going forward. China's socioeconomic evolution is affecting the global economy and definitely manufacturers. I have been all over the M&T footprint and talked to so many people who have been affected by the shutdown of supply chains. Steel manufacturer that has all of the ingredients for the things that they make except one particular resin that needs to be sprayed. I don't know how to make this stuff, I'm just repeating what I was told. But those supply chain challenges have significantly been a hindrance. And of course, we're seeing China go through its reopening now. We expect those supply chains to improve. But on a longer term basis going forward, what we see is China withdrawing itself from the position that it's had for the past 20 years of being manufacturer to the world. This is a simple timeline that we break into deflationary and inflationary forces. And we go into a lot more detail in the report, but essentially China was admitted to the World Trade Organization right around the turn of the century with a whole lot of really low-cost labor, took on tons of manufacturing in their country, and has changed since then. Labor has become more expensive, they've come more into their own, but for those first 20 years were a huge downward pull on the price of manufactured goods. That's going away because they are higher cost, and not also are they higher cost, but they are consciously making a decision that they don't want to just be a manufacturer to the world, but they want to be a self-sustaining economy, internal consumption. And that is a challenge. Yes, a lot of things are made in different countries now, and supply chains have spread out a little bit, but there's no other country or no other combination of countries that has the same kind of pool of low-cost labor that China provided for the 20 years before that. I promise this is not a picture of the virus. This is a picture of China's growing influence and integration in the world economy over the course of years. So that center area is China when they basically had one major trading partner in 1999, and each little circle is another country's, their contribution to another country's value add. Value add is just simply a whole bunch of parts show up, let's say for a cell phone, China puts them together, adds value to that unit, and then sends it somewhere else. That's like their role. And then in the sort of the middle purple circles is by 2009 becoming more integrated into other countries' supply chains. And then the last year of data, 2018, integrated into so many countries' supply chains, providing so much value add across the globe. And really our story here is while China makes the conscious decision to pull away from being manufacturer to the world, all of us are going to be feeling that in supply chains as companies search for somewhere else to manufacture, somewhere else that they can set up shop, somewhere else that they can find labor. And that is going to have an upward pressure on goods prices, and it provides a challenge for the future. And then the last theme that when we think about inflation and sort of these longer term inflationary forces is energy. Energy's tenuous transition. Do you like these titles? Each of them went through like 7 or 8 iterations. I think we spent more time trying to find the word tenuous than we did actually writing the report. I credit my colleague Megan Hsu with coming up for an analogy for this tenuous transition from fossil fuels to alternative energy sources. And we put it in the report. She says it's like a runner trying to pass the baton to another runner. And I don't know if you've ever watched racing. In the Olympics, it always goes pretty smoothly. Every once in a while, you see a dropped baton. I can tell you that my kids run track, and they have dropped many batons. And that is when you've got two people working together to achieve a common goal. The fossil fuel industry and the alternative industries are not like two runners that are working together to achieve a common goal, because that's simply not how it's set up. The fossil fuel industry has seen the energy transition coming for quite some time, and this is the decline in capital expenditures by the 5 largest petroleum producers across the world, and their CapEx has declined by 50% since 2013. I don't know if any of you know about the oil industry. My father worked in the oil industry for 35 years, but it is a long pendulum swing of CapEx. You have to go out and find the fields, and then you have to prove the fields, and then you have to set up the drill out of the fields. And a 50% decline in CapEx by these majors means that we don't have as many proven reserves as we would have if they had not seen this transition coming. I'm not saying anything like it's good, bad, or indifferent that the transition to alternative energies. I'm simply the economist that's saying they have cut back on their ability to produce petroleum as we go forward. And if it was a situation where we would be moving off of petroleum, that wouldn't be as challenging. But the International Energy Agency, in their projections for total energy supply from last year, the data from 2021, projecting forward to 2030 and 2050 as this transition is made, yes, has renewable energies moving up from 12 to 17 to 29% of total energy provided. But oil, 29, 29, 27. We need that black stuff in the ground. This could change if countries make different decisions and sort of accelerate the development and try to wean off of petroleum. But I'm here to tell you that we're still going to need a lot of petroleum, just as that industry, or that runner with the first runner with the baton, is slowing down for understandable reasons. And that creates that upward pressure on inflation over a multi-year period. This is our 2023 forecast, but it is really a multi-year look at some of those longer-term things. And I don't think it's all negative. I mean, I realize I'm the wet blanket, I'm the dismal scientist, I'm the economist that comes before you and says, here are some of the challenges. But again, we are projecting that inflation is not going to stay high at 9%. As you saw in that first chart, we're just talking about it being higher than it was in the intervening period over the previous 10 to 15 years when it was so low. We're still talking about 2.5% to 3.5% inflation. The impact is higher interest rates. You know, the Fed had interest rates at 0 for most of that intervening period. They're going to be higher. Now you're going to have some moderately higher inflation. That affects financing costs. It also affects the flows of capital. You know, it's more attractive to be in fixed income now than it was beforehand. But in some ways, it's just a return to a more normal environment than we had before the global financial crisis. As we look forward to this year, 2023, we have 3 scenarios. There's the soft landing scenario as our economy slows down. We put about a 40% probability on that. The middle scenario of a mild recession, we put a 55% probability on. And then there's the severe recession, or the really, really hard landing. We only put 5% on that. It's really a game of trying to figure out whether the US economy is going to escape recession, so to speak, in 2023. Like I said, we have a higher probability on that mild recession right now, but I have to say, over the past couple of weeks, some really encouraging data, both in the US, also in Europe, has me pushing back towards a coin flip between the soft landing and the mild recession. And ultimately, what it comes back to is, our consumers going to continue spending, and our business is going to continue investing in CapEx, or will they pull back? And I think that a lot of that data and a lot of that outlook is still very strong. We have strong job growth. We have expectations of strong job growth. Wage growth, luckily, is decelerating. I realize that labor costs are still high, but we have that need to hire. You've got most of the respondents in your survey reporting that they plan to hire over the course of this year, more than 70%. I think that's incredibly positive for this area, because that's a reflection of strong business conditions here. And also, as I mentioned before, on net, the majority, almost a majority of respondents to the survey expect to be investing in more CapEx this year. Almost the balance, almost all, expecting to keep their capital expenditures level, and only a very small portion in this area are expecting to actually reduce their CapEx. And I think that that means very positive things for this local economy as you move towards that huge investment that's coming from Micron. And it's going to drive the need for more jobs, to attract that labor here, and to build the skills that are necessary in an environment where we know that the labor markets are challenged. Even at the national level, our outlook for this year, when I say mild recession, chance of 55%, it's not even a negative for the entire year. A flat growth of 0.3%, because a couple of quarters in the middle would be negative. This would actually be on par with like a 2001 recession. 2001 recession was actually incredibly mild in the United States. Consumer spending never went negative. There was a decline in CapEx. and really low government spending as sort of the mechanics of how we got there. There was a big decline in equity markets, but 2001 was a very mild recession where the job losses were fairly limited. We are not expecting something like the 2007, 8, 9 experience at the national level. And also, as I said, with this as our national outlook and with so much positivity being reported in the local economic forecast by CenterState and by that large investment that's coming, I think we can expect a more positive outlook here, especially on a multi-year basis as you go forward. So thank you very much. I really appreciate you having me here today, and I look forward to the rest of the event. Thank you.